Hey traders and investors, it's Chris Vermeulen from the Traders.com. I want to give you a high-level view of what's unfolding in the markets the last few trading sessions of the year and what to expect in 2025 among stocks, bonds, precious metals, all kinds of different assets. I want to hit it from a high level, and then I want to show you what's unfolding, an opportunity for you guys to take advantage of all this as the year unfolds, the new year. Now, more or less, if we take a look at this market, we had the 2000 tech bubble, went into a 3-year bear market. We had the 2008 financial crisis, which is about a year-long bear market phase. We had the COVID crash. We had the 2022 mini little bear market. It only pulled back about 25% or so. And then we have this new major market top unfolding. And let's just quickly dive in from a really high level of how I kind of come around to this. Now, there's a lot of things unfolding, which if you go to my website and opt into our free newsletter at thetechnicaltraders.com, you should see it at the top. You can download this PDF where you can understand and get this large infographic of the stages, how to identify the stages, the market participant mindset and what the average investor is doing, the stock market cycle and what to look for, the economic cycle, which is kind of really interesting of where really kind of connects with a lot more people where things are. I'm going to touch on this a little bit in this video. And then you need to understand which strategies are optimal for the current stage we're in, which I believe we are still in this stage 3, the stage 3 topping phase, which really our CGS strategy or options trading strategies are the key for making turning profits, no matter if the market is going up or down, and they can continue to make money as we enter into a stage 4 financial reset, a bear market. So let's kind of dive into some charts here. Take a look at the SP 500. I haven't really seen anybody talk about this, but as you know, if you follow my work, I'm a huge believer of Fibonacci extensions. It really allows me to figure out where price targets are. It's how we traded the last big rally in Bitcoin over the past month for a 40% gain in about 4 weeks or so. But anyways, we have the COVID low. We have the high that we put in 2021, early 2022. And then we bring down to this low. And this brings us tells us where the upside target for the stock market should be. You can see we've hit the 618 level. And as you know, if we hit 618 and pause, which we did for 3 months, usually we're going to go up and hit that 100% measured move. And that is exactly what we have done so far in December. We are also expecting the holiday rally, November, December up into the highs, and we have had that, and we've hit this 100% measured move. So this is a little bit of a warning sign that, hey, the momentum could stall out, and I have been talking about even in podcasts and with obviously subscribers about what I think is going to happen in January and 2025, which looks pretty bleak. And if you do not have a game plan and strategy to identify trend reversals and opportunities, 2025 is going to be very painful for most people. So from a really high level, I believe we are in a stage 3 topping phase for multiple reasons. The key reasons really, if we go down here and take a look at the stock market cycle, it has to do with gold having that big extension move, just like it did in 2006, 2007, where it just took off and rallied before the market topped. We have energy stocks outperforming, reaching new highs, and we have industrial capital goods. So let's look at all of 3 of those very quickly. And I really kind of want to lean a little bit more on the capital goods because I haven't really touched on that too much and showed that side of things. But if we take a look at gold, the key play right here is it started a major super cycle back in early 2000. And then we went into let me just grab a marker here. We went to a multi-year pause. And then suddenly out of nowhere in 2007 up into early 2008, gold took off and started to outperform. And we've kind of done the same thing here. We broke into a new super cycle in gold in 2019. It just had a multi-year pause. And then, of course, it has been a leading mover over the past several months, having that 100% measured move to the upside. And gold is the global barometer. When gold takes off and starts to outperform, we know the world's nervous. There's generally bubbles in all asset classes, real estate, stocks, currencies, depending on where everything is. But there's bubbles, and people are nervous, and they want to get out of the financial system, hold physical gold because they're worried about currency issues, worried about defaults, banking issues. And if we were to just quickly do a Fibonacci extension on this so you can get an idea where gold is, We had the low here in gold back in early 2000. We had the top in 2011, and then we had the low down here in 2015. If we draw that, you can see how gold had the run up, the pullback, hit the 618, pause for a little while, and now we've hit that 100% measured move. We sold our GLD position right up here at our target, at around up near that 2,700 mark, and now gold is probably going to go into some type of correction and pullback, and we saw gold pull back about 34% during the last financial crisis in 2008. Silver pulled back about 60%. So I do think we're going to see gold eventually here unfold and pull back 15, 20, 25% or so in 2025. Now let's go take a look at the energy space. We got huge divergence in the energy space. Let's look at oil first real quick here. Again, I just want to skip through this from a really high level. But long story short is we have had oil moving down for the last several years. It is at a critical pivot point on the chart where prices either stuck below it or above it or underneath it, and it is just treading water here. And I think we just need some poor economic data, and we're going to start to see this break down, and oil is going to collapse probably to about 45 bucks a barrel. Now, oil has been going down, yet if we take a look at energy stocks like XLE, it's been doing the exact opposite. It has been moving up. It is trading near all-time highs like in 2008. We also had it trading at highs back in 2014 before we went into another economic weak period. And again, it's back up at these levels. Yet it's going the complete opposite of oil itself. And I believe everybody's positioned in energy stocks for a few reasons. One, people are worried about World War III. Also, people are expecting if that happens, oil is going to shoot up to $200 a barrel. So they're positioning in energy stocks to make big profits. And third is a lot of energy stocks pay big dividends, and most retirees, most investors are heavy into big blue chips and the dividend paying stocks. And so they keep going into these and driving these stocks up. And I did a video last week or a week and a half ago on the dangers of dividend stocks, how you actually carry way more risk than the stock market itself, how it's going to cripple and really is a ticking time bomb for most investors. So if you haven't seen my past video on dividends, you should definitely go and watch that as well. So anyways, energy's overpriced. And then last but not least, let's take a look. Let's look at the industrials. If we look at XLI, this is the industrial space. This is that third part of the market that takes off really, really big and starts to outperform because the economy feels, everybody thinks they're doing really well. Businesses are strong. And so we've seen the industrial sector take off. And of course, if we look at the Dow Jones Industrial, which is obviously industrial stocks as well, it has been rocketing higher and has been hitting its measured move likely as well to the upside. So when we go back and look at this infographic, industrial capital goods, those companies, we have all kinds of business managers and warehouse managers upgrading their facilities, their assembly lines. They've had several good years of sales, and they think things are going to keep going. And it's just the way it works. Just as everybody upgrades and thinks business is purring, they run into a downswing in the economy. And so we're in this global expansion. Even though the stock market, I believe, is topping, the yellow cycle here, the economic cycle, people are still ambitious and still upgrading, and that's why industrial companies are still doing record sales and upgrading their facilities. But they're really doing that at the top of an economic peak. And then, of course, they're going to go all the way through the cycle and lead to bankruptcies and all of that stuff down the road and layoffs. So that's kind of the three key things that are unfolding from a big picture view. Now, if we step back and take a bigger look. Now, this is a line chart, and this is the COVID crash on the left-hand side. This is the VBIAX. This is a Vanguard 60/40 portfolio, the typical buy and hold portfolio. You can see once we had the COVID crash, the market generated a new bull market signal in 2020. The market is up about, this portfolio, the average buy and hold portfolio is up about 28% over the past several years. It's not huge, but it is a return. Now, if we were to look at it compared to our technical investor strategy, which comes as part of the bundle of my asset revesting strategy, and we use this for part of our identifying our signals and underlying trends, you can see we have the same signal generated about 41% return on the first trade. Then we had a bear market signal. We got out of the market, re-entered, and the current position is up about 47.62% from entry. Now, the buy and hold portfolio is up 28% over 1, 2, 3, 4.5 years, which isn't really very good, versus a strategy of identifying when we're in a rising tide environment, when to step aside and then reinvest it all for the next rising tide environment. And this has generated about 108% return. That's not even including the dividends that get paid out a few percent each year that you're holding. So this is the difference when you apply technical analysis. You apply the stage analysis, a bullish phase, bearish phase, manage positions, and all of that stuff. So from a high level, this is kind of something that we share, and I think we're getting very close to another bear market phase, except for this bear market could be very ugly. It could be a 35 to 55% correction in 2025. And anyone holding dividend stocks, blue chip stocks, are going to get hit harder than everything else. Again, go back, watch my dividend video of the ticking time bombs most retirees are holding in their portfolios, and the death of the 60-40 portfolio that will cripple most people in retirement. Now, one of the strong suits of the strategy that I share and I teach and I provide signals for is identifying which asset class is in favor. On the top here, we have the SPY, which is the SP 500. On the bottom chart here, we have TLT, which is the bond chart. And this is a perfect example of why the 60-40 portfolio and holding both bonds and stocks are a terrible idea. You really just want to own the asset class that money's flowing to. The strategy I use identifies, tells us what's going on. We're long the bond market. Our strategy said, hey, money's moving out of bonds. It is about to start a downtrend, and money is rotating into stocks. We closed out our bond trade, moved into the equities market, to the SP 500 and the QQQ. And you can see the difference here in terms of we've seen the market go higher for stocks, and bonds have gone the opposite way. And obviously, if you have a mix of these, one goes up, one goes down, you've pretty much killed all of your returns. One neutralizes the other, and diversification really is not a good thing. You really don't want to have diversification in your portfolio, because you're always going to hold some that are losing value and killing your performance in the other assets. Okay, so let's zoom out. Let's look at the big picture here of our strategy, our signals for the SP 500. We can go back to the last key market top that we had back in 2022, where the stock market topped out. If we were to just look at that, you can see the SP 500 from that high is up about 23%, which isn't too bad, but it's been a roller coaster ride through that whole time. Now, if we were to flip and take a look at the 60-40 portfolio down below, let me just clear this here. You can see the difference in terms of returns and why a balanced portfolio sounds like it should be good, a balanced portfolio. But when you have stocks and bonds, you have just gone more or less 1, 2, 3 years with almost no return. And that's why things are so dangerous. You really got to be very cautious with that. Now, what I do with the strategy that I share is the CGS strategy, the consistent growth strategy, is this top line. No matter what the market does, when it pulls back like in 2022 or the bear market in 2028, we have a strategy where we're constantly just moving our money to whichever asset class is moving up, and we're able to consistently grow our account and move higher. Now, we are hitting new all-time highs right now. We haven't closed out the positions we have open in the equities market, so we are trading higher at new all-time highs, but we don't update our performance until we've locked in the gains and it's been booked. So that's kind of one of the key things to understand, is knowing which asset to move into and which ones to dump, because they're going to pull on your performance. Last but not least, let me just touch on our BAN strategy, which stands for Best Asset Now. This is where we trade the 3 hottest sectors whenever the stock market has a new buy signal. One of the trades was the ARKW ETF. You can see on the bottom, this is our trend analysis telling us when the stock market is favorable. And if it is, when it's green, we want to move into a leading sector. We got into the ARK ETF and it has taken off. It hit all of our targets. We have officially closed that trade out. We also did we had a couple other trades, all winners. We had 5 positions in total actually for that, and all of them are in the money and closed out. We still have 1 position open, but a recent one we also did as a bonus trade was this Bitcoin trade. We had a buy signal. The monthly chart was epic. And I said, guys, we got to take this trade. This is just too good to pass up. We got into the trade. A couple days later, we hit our first target at 14%, and we ended up closing it out right up near the highs because it hit our 100% measured move, which was a 40% gain, and it has been pulling back ever since and looks like it wants to unwind. Again, Fibonacci extensions, they tell us where our first target is at a 618 extension and a 100% extension, and that is exactly what most assets do when they have momentum behind them and there's herd mentality of money flow. And that's kind of how we go about attacking things like that. So anyways, if this kind of stuff interests you, you want to be on the winning side, you want to be holding the assets that are going up, you want to not worry about the markets topping, then I recommend you come to our strategy, the CGS strategy at the Technical Traders. And if you want a quick rundown of what I provide in the newsletter, you get 3 different strategies. It's called the Total ETF Portfolio. You get our bull and bear market cycles where you can just have these big, easy trends to trade. You get our banned sector trades, which when the stock market has a buy signal, you can own the hottest sectors, catch those as explosive trades. And then, of course, our CGS strategy for big accounts that want stability, low volatility, and above average returns. You can do all that. And this page, if you come to our website and come to services in the CGS Signal newsletter, you can come through here and see what we teach, what we do, some of the biggest lies, which is diversification and that bonds are safe. In fact, they're one of the most deadly assets you can do, along with dividend stocks. Why you don't always want to ask your advisor for help, because they really don't know how the markets move. They're built, and the financial markets are designed for them to make money and not really have to protect you. All that stuff. But there's lots of stuff in here, video interviews of members talking about our service, how you're going to save time by diversification, how we rotate through sectors, how we manage our trades, hitting targets, moving stops up, all of this stuff. This is a strategy based strictly on momentum, on technical analysis, position and risk management. You can learn more about the strategy in this video here, but this one page has got all kinds of stuff that will open your eyes to what we're doing. And of course, you're going to get the Technical Investor newsletter. You're going to get our banned trading strategy here. It's a $1,400 value where you get the hottest sectors. You're going to see how you get these explosive trades that last 1 to 2 weeks and can be anywhere from 5 to 20 to 30%. If you're an options trader, very, very powerful stuff. And you get our 7 hours of technical analysis courses. You can learn how to read the charts, draw analysis. You can use auto trading, have it traded for you in your brokerage account. We have live mentoring sessions twice a month. We come in, you can ask all the questions you want. We go through the charts and you get all of this stuff. It's about a $10,100 value, and you can get access to it for about $2,400 for the year, which is pretty powerful. If you get the full bundle, it's $2,999, but really it works down to one winning trade pays for it, or you avoid one market correction, you would have paid for it, and you can profit from a market correction, which is even more exciting. It will pay for the service. Much cheaper than an advisor, paying fees. And of course, you have auto trading where it'll literally trade my trades for you in your account, and it'll pay for itself. So that's some pretty powerful stuff. Again, lots of testimonials from members, all of that stuff. And really it comes down to less than a coffee from Starbucks every day to get everything you need. Higher returns, lower volatility, less stress. Just copy the ETFs trades that I do with my own portfolio, and you can take advantage of that. So if any of that's of interest, make sure you join. We have this special is going to be closing its doors here come the new year. And if you want to lock in the profits, lock in the discount and the bundle package, make sure you join. Anyways, take care. Have a great week, and talk to you soon. Bye-bye.